The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
What do we make of Wednesday's trade action? We got a lot of things swirling around this market that we need to discuss, a lot of outside market pressures and headwinds, the potential of a government shutdown. We got USDA reports coming up here on Friday. There's a lot to unpack here to help us try and make sense of it all. We welcome in Mike Zuzolo, president of Global Commodity Analytics, our guest analyst here today on Market Talk. Mike, thanks for joining me here on the show as always. Hope you're having a good week so far.
Great to be with you, Jesse. Thanks for having me. I'll tell you about the week once we get through Friday's close. How's that sound to you?
That sounds good to me. I think we can definitely agree on that here today. Just with the way things have been going, like I mentioned, there's a lot to unpack. The wheat market on Wednesday, I think that's a good place for you and me to start because we talk about the wheat market being the leader quite a bit. I mean, double-digit losses in Kansas City hard red and Minneapolis hard red spring wheat and KC wheat, winter wheat, spring wheat, Minneapolis. Chicago wheat was down as well. I don't know. Walk us through what you're seeing in this wheat market. Let's just start there. I'm trying to make sense of the wheat market being down moderately, quarter beans being a little bit higher though on Wednesday. That doesn't make sense to me.
No, it doesn't. And I think first and foremost, I felt as though this market was going to be harder and harder to gauge and understand as we got closer to the end of the week, which is also the end of the quarter, obviously end of the month, but it's also the end of the fiscal year for a lot of the financial investors. And I think the spread trade is getting very, very exciting and volatile and highly driving prices instead of maybe following prices. And I think the hard red wheat is what I wanted to talk about a little bit today because it is the tightest supply wheat out there that we have in the United States. It's been the one that has been the long side of a spread against the soft red wheat. I'm almost wondering, instead of one of two things I think could be happening here, Jesse. Instead of the hard red being the leader as we go into the end of the quarter, we're unwinding hard red, soft red spreads. If that's not occurring and the wheat is going down because of the new almost 1 year high in the US dollar index being made, and this is pretty important here because we've crossed through that 50-month moving average on this chart. This is the monthly continuation for hard red. We've also taken out last month's low of that 705, 704 area. We've now gone below $7 on a close and really taken out one of the last key support levels until you get all the way down to the green long-term trend line of around the $6, $6.20 area. And I'm sitting here thinking, why in the world would we be doing this when the Paris milling wheat and the European markets are actually holding gains and we're back to $1 discount in soft red wheat minus the Paris wheat? And I think it's either the spread trade or the hard red wheat, unfortunately, could be leading us and telling us where the rest of the commodities are headed as kind of a leading indicator. And it's almost as though the trade may be seeing the United States wheat market getting worse and worse and almost selling the hard red wheat instead of selling something like the US dollar. And I know that's a stretch, but this is a big deal to me to see at the end of this month and end of this quarter and end of this fiscal year, the hard red wheat lead the market lower. We absolutely needed in my opinion, a low in this market, in the wheat market, in the month of September to be able to set us up for a seasonal low in the corn and beans.
Well, that is an interesting perspective, Mike, and it's quite interesting and fascinating with the fact that you mentioned the U.S. dollar going up here to near new highs. I think yields on 10-year treasuries, fresh 16-year highs. I think it was something like that on Wednesday or close to it. I mean, there's a lot of financial-esque headwinds out there in front of these markets, or fodder out there in front of these markets, it feels like right now.
I think so too. And I think ever since last week's Federal Reserve report, what we talked about has come to fruition, in that higher for longer means more pressure on commodities for longer through the bond yields and through the dollar. And this chart is the US dollar against the Brazilian real currency. And this goes back to what you talked about a minute ago about how we had a little bit stronger price action in the corn and beans today. Was that due to the report? Was it due to spreading? All I can say is I think a little bit of both, but I would not bite into the apple that the beans and corn are making a low here this early in harvest, especially without the wheat, and especially given that we're now at the highest level, the strongest level in the US dollar against the Brazilian real, going all the way back to May now. And so our crop just is getting more and more expensive as the Chinese currency is also weakening against the US dollar. So their buying power is going down. Brazil's selling power is going up. I'm just not in the camp of the beans trying to make a big stand here all by themselves.
You mentioned the Chinese currency too. I want to look at another chart you sent me, looking at the dollar and the yen versus, or excuse me, the Japanese yen. Just kind of segueing over to Asia, but talking China or Japan, etc. Corn futures too. I mean, that's an interesting point you bring up. Just looking at all these correlations with different currencies around the world, Mike.
Yeah, two things here. The Japanese yen I chose, because China is starting to manipulate their trading ban, and so you're not going to get as clear of pass-through of the exchange rates and how the market feels. Asian markets have done horribly this week. We made a new low in the Hong Kong Hang Seng Equity Index. Evergrande is in trouble. That big property developer we've been talking about for about a year. It's not getting better in China. It's getting worse. And so the second reason I wanted to jump over to the Japanese yen against the corn is because ever since I got into this business in 1995, which was a really exciting time in the currencies, it has been one of the key leading indicators against the corn market, especially in terms of market sentiment and fund and investor sentiment. And the Japanese yen has a practical aspect of it too. Obviously, the beef exports out of the United States, the corn exports, and grain and oilseed exports out of the United States, they're one of our top 5 buyers pretty much in everything that we have in agriculture. And I think this is where we are now going through the 2022 and 2023 levels now into the Japanese yen weakening against the US dollar, getting close to that 150 yen. So each dollar would buy 150 yen. And that takes you back to levels not seen since 1990. And if you take a 30,000 foot view of this chart, Jesse, you see the Japanese yen in red. Whenever it's up high, the corn tends to be very, very low. And when the yen is very, very low, that's when the corn really can take off. This is where typically what happens is the fundamentals support the corn, but then also the funds, the investors support the corn as well. And you get that carry trade, as they call it, in favor of buying commodities because of inflation typically taking hold. So other than the Brazilian currency and a couple other currencies, the yen's a really big deal as it weakens here now to levels not seen since almost 1990.
No, great perspective, Mike. And I should throw in here as well, crude oil. I mean, crude pushing up 3.5% on Wednesday. We see all the tightening of supplies, and I know Russia halting a lot of their exports of gas and diesel. So typically I would think crude oil is supportive to the grains, but I think with some of these economic outside factors, I think that's limiting crude's ability to help support grains more than maybe they are. Maybe it is right now, Mike.
Yeah, you make an exceptionally valuable point for the long-term hedger in the grain markets, Jesse, is you've got to have the dollar going down when the crude's going up, if you ask me, to be able to see that transmission over into the grain complex. You can get it for a day or two or a week or two or whatever in the bean oil, and maybe get it in the ethanol for a while. But what you really want to see is the dollar going down and the crude oil going up, because that's a green light on both sides of the trade that inflation is coming in, and that's a green light to buy commodities. You're not going to get that with the Federal Reserve policy. So instead, what you're getting is the worst of both worlds. And I think, quite honestly, the higher the crude goes now, the more the trade in the equities markets and the cattle markets will react negatively, because I think the trade's finally gotten it. what we've been talking about literally for 6 months now is if China is weak, Europe is weak. If we lose consumption here in the United States, why wouldn't we go into a recession? And I think, again, after the Federal Reserve spoke last week, they really put recession on the table as far as driving down their aggregate demand enough to meet their inflation objectives. And I think that's really, at the end of the day, what all this volatility is about, and why we're seeing crude and the dollar go sky high together. Absolutely abnormal in most markets, but it can be done for a time because of monetary policy. And I think if we breach that $100 level in WTI crude, which some of the big investment banks are talking about, I think that just opens up the downside for both cattle and for the equities markets. And you've seen that linkage really develop this week pretty significantly.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics. Mike, great points so far. I want to stay in grains real quick before we discuss the cattle trade a bit more in depth. Soybeans, pull up the November soy historical chart here on the video feed for us. You look at the bean market right now, Novi beans trying to kind of hang around 13 on the board basis. This is that time of year where we start to see more shipments of beans, U.S. beans, to overseas customers. Still kind of waiting on that. I'm watching some of the basis levels, though, the Gulf out west and the PNW and more. So I have my eye there, but I'm also just curious what you're watching in this soybean market as a whole, Mike.
I'm extremely nervous at this point, Jesse, and you nailed it with the basis levels that the 2009 and 2008 price action that we saw in October of those years, where we actually slip another dollar potentially or more against the 2023 futures, and we break from the 2013 futures either because of the grain stocks report at the end of this week and or because of what's happening with the Mississippi River. The Memphis levels in the Mississippi River are just too low, and it's going to be very difficult to get those levels back to where we can do full drafts again and bring these sky-high tariff rates and extra charges for barges down before we get into the really big heart of harvest, like 40-50% soybean harvest levels. And it's really starting to make me nervous that we're going to lose, between both the currencies and the Mississippi River export market, a lot of the potential bean export demand, and we'll have to rely almost solely on the PNW. But those numbers are going up as well because the trains are already getting ahead of what's happening on the Mississippi River. So it's a big deal this next week, because what you notice in this chart is the blue being 2013. We did go lower, and then after the grain stocks report, and then we kind of solidified and went sideways. 2008, we went lower and never looked back. And I think that's a really big deal, sitting up here at this above $13 a bushel. And we've got, in that month of October, also the November going into delivery. So I think bought puts in the beans are an extremely good idea to think about if you're seeing yields better than you thought, which is what I'm hearing in more areas than not.
All right, I got to ask you about this feeder cattle market because, man, Tuesday's trade, a huge downturn in feeders, bit more follow through, it looked like, on Wednesday as well. And I think a lot of this ties into what you were talking about earlier about the economy and more. Walk us through your thoughts in feeder cattle. It's been a rough 48 hours here, Mike.
It has, and it may just be beginning. And I think the fat cattle have a little bit more support from the cash market, especially after the cattle on feed report. But those placements numbers on the cattle on feed report and how the Oklahoma City cash feeder market has been acting these last couple weeks really makes me concerned that we may be hitting that cycle high we've been talking about. And that's where this monthly chart comes into play. We're already dipping into the July high of 251.30. We've got a month end coming up here in just a couple, 3 days. If we take that 251.30 level out, then all we have next for support is that trend line, the blue trend line. And notice there's 3 trend lines. And I have worked on these types of markets enough, Jesse, that whenever you get 3 trend lines developed in a support or resistance, you're probably maxing out the upside or the downside. So I think we need to go back to that blue trend line around 240 and pick up the bull again and see if the cash market picks us up again. So this week's close is going to be extremely important because it's also a monthly close.
Very, very good points there. And I know too, when you look at the feeder corn ratio, that's another big thing to take into account here with corn trying to hold around this 480 level temporarily here right now. You factor that in with this feeder market. That's an interesting thing, I think, for a lot of folks to keep in mind right now too.
Yeah, and this could be a very good explanation for why the corn did not want to give in today, along with the European corn staying strong. Because here again, we have this three-line rule that I call it. If we violate one line, we're probably going to have to test the next line and really test the resolve of the trend in the bull or the bear. Well, we've tested and gone through the green line. That happened within the move between the green line being tested and now the blue line being tested as we again go into the end of the month happened within 2 days. I mean, that's how fast the funds move. And it's like many of these parabolic markets, parabolic meaning when you go straight up the flagpole, it's not necessarily about the cash market right now. It's really more about the funds and the technicals and the investors right now. And that's why that blue line is so important. We need to hold that 0.5, 0.52 level in terms of the feeders being premium to the corn, or we really lose almost all of our recent strength in terms of the technicals. And so this is why I talk about the potential cycle high is more between this type of price action and this type of momentum developing in the markets, and the trade kind of just puts their blinders on and kind of ignores the cash trade. And we did this in 2014 as well. We broke in 2014 hard. We retraced in 2015, but then we essentially went down from April all the way into the end of the year in 2015. Even though we were retaining animals again and trying to rebuild the herd, it didn't matter. The price action got ahead of the fundamentals. And so this chart says to me in feeders, you're essentially trading $8 corn right now. What are you going to do about it? You've seen the high and you didn't get the bullish reaction from the cold storage report early this week, and the market didn't buy the dip like it normally does. These are huge flags. You got to make a decision, I think, on how you're going to handle it.
And you mentioned that cold storage report, and I'll throw in too, and we can rope the hogs into this discussion. Hogs and pigs report out on Thursday. So I know that's going to be another talking point in this market overall. What's your take on that in the hog market?
Yeah, overall, my take is the hogs are a follower at this point. China did see a big jump in their prices, but that's because they're pulling stocks off the market and putting it into reserve. So it's kind of a false demand, and they're taking supplies off the domestic market. I think hogs probably have good, solid foundation here in price action in the first couple, 3 months of trade, Jesse, because they seasonally win at this point. But if we see the equities markets give way, I think the hogs could willingly follow the cattle down once we adjust that cattle hog spread that got so far out of whack.
Mike, great thoughts. Before we wrap it up today, I know we could go on and on. There's a lot to cover here, and I know neither one of us wants to get political. There's the potential of the government shutdown throwing a monkey wrench into everything in front of us here. But the USDA reports on Friday going to be very big and key, as we touched on that. So just with all the stuff that is swirling around these markets right now, I guess to sum it up, what would you tell folks to keep in mind here as they're watching things unfold towards the end of this week and dealing with harvest and so much more on their plate?
The dollar is too strong right now, Jesse. If we go into a recession and we have a government shutdown and we also have this UAW strike, we just don't have the legs underneath us economically to keep demand going, in my opinion. Why? Because the Federal Reserve and a lot of the bulls out there on GDP for the United States are saying the consumer is going to hang in there. We're starting to see the consumer give way. It's only going to get worse with higher energy prices and some of the things we're talking about. So until that dollar breaks, though, you got to be defensive because of the potential for the Mississippi River to really curtail our export potential and that cash basis to keep weighing on us. But a lot of stuff we talked about. Just reach out individually if you need to. Call me toll free, 866-471-2588, or go to globalcomresearch.com. Shoot me a text on that sign up sheet for a 2-week trial and say, give me a buzz. I got a question, or write your specific question. I'll be happy to get back to you.
Globalcom with 2 M's, research.com, globalcomresearch.com. That is where you can get a hold of Mike Zuzolo from Global Commodity Analytics. Mike, always great to talk with you. Thanks so much for the time. We'll talk to you next week.
You're so nice to have me, Jesse, and you do a lot of great work in times like this, and I really appreciate it. And I'm sure the listener and the viewer do too.
Well, likewise, I do appreciate your time. Mike Zuzolo, thanks for joining us here today on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.